Have you ever wondered why wealthy people often seem to pay less in taxes than everyone else? It's not always because they break the rules. In many cases, they simply understand how to use the system differently. Through investments, businesses, assets, deductions, and long-term financial strategies, the rich often reduce their taxable income in ways most ordinary workers never learn about. Today we will talk about how the rich legally avoid taxes and why you're paying more. So before we get started, make sure to hit that like button, also subscribe to my channel 10. Most people think taxes work the same for everyone. Most people grow up believing the tax system is simple and equal. You earn money, the government takes a percentage, and everyone more or less follows the same rules. Because of this, many workers assume that rich people simply pay larger amounts because they earn more. Technically, wealthy people often do pay large amounts in taxes, but the important detail is how they earn, structure, and protect their money. The tax system does not only reward income, it rewards certain types of financial behavior. And this is where the biggest differences begin. 9. Employees usually pay taxes before they touch their money. For most workers, taxes are automatic. You work, receive a paycheck, and taxes are removed before the money even reaches your account. This means employees have very little flexibility in how income is taxed. The system is designed around direct income reporting. Wealthy people, however, often do not rely mainly on salary income. They earn through businesses, investments, assets, ownership, and financial structures that operate differently under tax law. This creates opportunities for legal tax reduction that regular workers rarely have access to. 8. The tax system often rewards ownership more than labor. One of the biggest differences is that tax systems in many countries tend to favor ownership over direct labor. When you work for money, income is usually taxed immediately. But when you own businesses, investments, or assets, money can be structured differently. Business expenses, investment growth, depreciation, and long-term holdings often receive different tax treatment. This does not mean wealthy people are breaking the law. In many cases, they are simply using legal structures built into the system itself. The important point is that the rules are not identical for every type of income. 7. Rich people often borrow instead of selling assets. A strategy many wealthy individuals use is borrowing against assets instead of selling them. For example, if someone owns valuable investments or property, they may use those assets as collateral for loans rather than selling the asset directly. Why? Because selling can trigger taxes, while borrowing usually does not count as taxable income. This allows wealthy individuals to access liquidity without immediately creating taxable events. Most regular workers cannot use this strategy because they do not own enough appreciating assets to borrow against in the same way. 6. Businesses create tax flexibility that employees don't have. Business ownership creates many legal deductions and financial options that normal employment does not provide. Business expenses such as equipment, office space, travel, advertising, and operational costs may reduce taxable profit legally. Employees generally pay taxes first and spend afterward. Businesses often spend first on qualified expenses and are taxed on remaining profit later. This creates a major structural difference between earning as a worker and earning as an owner. Wealthy people understand this difference early and often build systems around ownership instead of relying only on salary income. 5. Investments are often taxed differently than paychecks. Another important difference is how investments are taxed compared to regular income. Long-term investment gains in many tax systems receive lower tax rates than ordinary wages. This means someone earning through investments may pay proportionally less tax than someone earning entirely through labor income. Wealthy people usually own appreciating assets like stocks, businesses, or real estate that generate wealth over time. Workers mainly earn through active labor. The result is that the same dollar amount can sometimes be taxed differently depending on where it comes from. 4. Wealthy people focus on assets. Most people focus on income. Most people spend their lives focused entirely on income. They work for money, receive money, and spend money. Wealthy people focus more on acquiring assets that produce value over time. Assets can generate income, appreciate in value, create leverage opportunities, and sometimes receive favorable tax treatment. This creates a completely different financial system. Instead of relying only on labor, wealthier individuals build structures where money flows through ownership. Taxes are often lower when money moves through assets compared to direct earned income. 3. Most workers never learn how the tax system actually works. One reason this gap continues is because financial education is limited for most people. Many workers are taught how to earn income, but not how taxes, investments, ownership, and financial structures really operate. Wealthy individuals often hire accountants, attorneys, and financial advisors whose job is to legally reduce tax burden through planning. Meanwhile, average workers usually handle taxes only once a year through basic filing systems. The difference is not only money, it is access to financial knowledge and planning strategies. 2. The system rewards long-term financial planning. Wealthy people often think about taxes before making financial decisions, not after. They structure investments, businesses, and ownership models strategically over long periods. Most people think about taxes only during filing season. This difference in planning creates major long-term advantages. Financial systems are often designed to encourage investment, business growth, and ownership, because governments want economic activity and capital growth. Those who understand how these incentives work can legally reduce taxes while building more wealth at the same time. 1. The real issue is not just taxes, it's financial structure. The deeper truth is that the biggest difference is not simply that rich people pay less taxes. The real difference is that wealthy people operate inside a completely different financial structure than most workers. They focus on ownership, assets, investments, leverage, and long-term planning, while average workers mostly depend on direct income. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.